Hello everyone, today is Friday, June 10th, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly presented by the Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves across financial markets. Now, if you're brand new to this video series, welcome. Thanks for being here. Thanks for joining us. Here's how we break up our analysis. We split things up into two parts, and in part one, we look through everything that went on this week in markets beyond price action. So we look at things like volatility term structure and correlations and interest rates and what commodities and the dollar are doing, and really sort of pick apart things that stand out, look different, interesting, or notable. And then in part two, we jump into those charts, we look at the longer term trends, we break down price action and try and best position ourselves looking ahead. So hopefully that sounds good to you. It was a busy week out there. Let's jump into some of what we're going to be covering in this week's episode. So the big story front and center here is we got fresh Nasdaq closing lows, weekly closing lows. I don't think we got there on the daily chart, but this is the lowest weekly close we now have. And really markets just fell apart, and it was primarily off of the heels, or the catalyst certainly was CPI hitting 40-year highs. 8.6 year over year was the number that we printed on Friday. And so that had the market really sort of just worrying and ratcheting up the rate hike anticipated interest rates for later this year to combat that inflation. We saw the short duration treasury yields all really just explode to new highs. We'll look at some charts of that later on. We've got gold and gold miners seeing a pretty major reversal on Friday, and we've got a trade set up, or we've got some studying to do in the basic materials sector all later in this episode. So let's jump into the numbers here. You can see it was a very painful week. On the right hand column, you can see it was 4 to 5 to 6% down across the board in all of the major indices. The Nasdaq 100 led us lower, 6.09% lower. The S&P 500 closely behind, Russell 2000 in the third spot, and then international stocks, so minus the United States, actually fared up a little bit better, but still down 4.2%. You can see 1 month numbers. This was looking pretty positive last week. We were putting in some nice green numbers, and now we're starting to give most of those gains back. The Russell is the only US index here that is trying to hold on to green territory. If we take a look at the trends here, so we sort of use the 10 SMA, the 50 SMA, the 200 SMA, just to illustrate the sort of different magnitudes of trend. And we're looking at the advancing or declining nature of the moving average. And you can see we are declining right across the board. So no matter how you slice it, we are in a short, medium, and long-term downtrend. And we are making lower lows, lower highs if you're looking just strictly at price action. Now, the VIX, or the S&P 500 Volatility Index, did rise this week. Surprisingly, for a 5% move, or a 5% lower move here in the major indices, it's actually not that big of a jump here. 2.68 points going up to 27.75. We're still off of year-to-date highs. We're still not north of 30. Don't get me wrong, a 27 VIX is still very elevated and screams, volatility and indecision and, just basic danger, to use a technical term. But it is not screaming higher. It is not being bid up and not taking out previous highs. We do have options expiration coming up on Friday, so we do probably have a little bit of interesting lead in there. If we take a look at Nasdaq volatility, it is higher. It's up at 34 going into the weekend. It's also up about 2 points. So both of these indexes are jumping, and VIX, or volatility environment, is elevated, to say the least. Our drawdown monitor. So this is where we were tracking the current cycle drawdown from peak to trough, and we do use intraday numbers on this. So for instance, the S&P 500 from peak to trough was down about almost 21% this cycle, and you can see if we look at the current drawdown, we're back down to about 19. So what this is basically showing us, just again to take a step back and understand where we are coming back down to the lows here, and frankly, next week we should be on watch to see if those lows can hold, and if we do start making bigger, deeper drawdowns this cycle. The Nasdaq 100 is down the biggest, or made the biggest peak to trough decline at 31.45%. It's just a couple of percent above that right now. So I wanted to take a look here at the treasury yields across different maturities. We have the 2-year government bond here, the 2-year yield on the top left, and you can see the very clean sort of big breakout here to new highs. So basically we're seeing interest rates continue to rise here, 3.06% going into the weekend. The 3-year yield in the top right, 3.23%, breaking out to new highs. 5-year yield breaking out to new highs. 10-year yield not quite breaking out to new highs. So essentially what this is showing us is, the market really sort of getting in front of the expectations that the Fed is going to continue to combat this CPI print, this inflation, by continuing to raise interest rates. They, of course, are more able to sort of, kind of dictate and control the real sort of short end of the maturities. And so when you go out to the longer dated stuff, we don't see quite as big of a move. You can also see, of course, that we've got some pretty good inversion going on here in the different maturities. Let's cycle our attention now to market internals. Market internals were something that were starting to, I guess, go at least neutral to slightly positive over the past couple of weeks, but we certainly gave that up this week. You can see that we did start to make many more new lows here, particularly on Thursdays when we saw the breakdown really in the market, and we saw the number of stocks hitting 52-week lows jump. And then on Friday, we saw it accelerate, really almost got like a follow-through day in the number of stocks hitting 52-week lows. And therefore, on the week in aggregate, we did get more lows being made. So this sort of backpedaled our progress, where we were, kind of evening out, balancing out, and essentially starting to grind higher here in the number of stocks hitting new 52-week highs minus lows. And then, of course, you see we are starting to dip back below and sort of continue this bigger trend lower. So this is obviously a concern here for the market. Again, just looking at internals underneath the hood, underneath the, let's say, indices that are very market cap weighted and dictated by 10 or 15 stocks. Sector performance here, you can see, was also pretty abysmal. We didn't get anything in the green. Usually you've got one savior. Energy has been it for the past year, but even that was down this week. It was down 0.89%. It is still positive 13.5% over the past 1 month, so it is one of the few green spots that are still holding, but energy, consumer staples, healthcare, those were the top 3 performers. Consumer staples and healthcare, of course, very defensive, 2.57% lower, 3.34% lower for healthcare. So really didn't do too much protection for you this week. On the downside, underperformers, financials really getting hit hard, 6.71% lower for that sector. That's a rough ride for financials. Technology was in the second spot and real estate in the third spot. Real estate continues to unwind, and having tech and financials down here both make that a very rocky, bumpy road. If we look at 10-day correlations, there's not a whole lot in here that's new. So basically, this has been fairly persistent. So just again, as a reminder, these are 10-day correlations. So these are very short-term, just looking back over 2 weeks worth of data, looking at how things move across asset classes, relative to one another. And we're basically seeing, all of the major indices move in lockstep with one another. They are highly correlated. So this always, or I shouldn't say always, but this basically tends to happen during heightened volatility environments, much like we're in. And we still have this very strong negative inverse correlation to what the dollar is doing. Surprisingly, or I guess no surprise here, the dollar was up was up big this week, while equity markets were down very big this week. So this really seems to kind of continue to persist here in terms of what's moving and what's working together. If we take a look at treasury yields, so again, we threw in that slide earlier, so we already hinted at this, but basically, you know, right across the maturities here, you can see everything was higher this week: 3.5, 3.25 for 5-year, 3.15 for the 10-year, 3.19 for the 30-year. And again, you can see that longer in duration was moving a little bit less this week, and we really saw the shorter ends moving abruptly. Last but not least, dollar and commodities here. You can see natural gas at the top of the list. This was the best performer here in commodity land. It was up about 2.62%, and it's not necessarily fair to say because we don't have all the individual commodities on this slide, but 2.62% higher. Dollar index up almost 2%. That's a massive move. Remember, the dollar pulled back over the past few weeks. We were talking about that pullback, and here it is, really catching a bid, putting in that higher low, and off to the races. Gold was up. Crude oil was also up. Ag was up. Silver, Bitcoin, only two losers here on this deck. Bitcoin has been pretty sideways here between, call it 32 and 28. It's been really sort of just moving sideways, and certainly feels fueled up, amped up for potential directional move soon. Last but not least, we go to our trading systems. Our top system here, Merlin, is a multi-week swing trading system, and it's actually doing some buying late in this week. That is a new change of character for it. Now, it is picking its spots pretty carefully here. We're going to talk a little bit more about it later in this video in part 2. So very, very selective. It's not necessarily out on the risk spectrum on high growth stocks. It's looking at a slightly different area of the market, but nonetheless, it did put some of its buying power to work. It's 29% invested. So again, still 70% cash, nothing too aggressive here. And our short-term system was short for most of this week, but started to balance out and actually get net long going into the weekend here. It actually only has one position on. It covered the remaining shorts on the open on this Friday, and does now look to, I believe, make some more purchases heading into Monday. So if either of these trading systems sound interesting to you, if you need some help navigating the market, take advantage of that $1 trial we have on our website. Basically, it teaches you a little bit more, informs you a little bit more about these trading systems, how they work, how they operate, how they may be able to help you. So check it out at thetraderist.com/trial. And with that, we'll be back here in just a second with part 2. All right, we are back. We've got TC 2000 open. We are looking at the S&P 500 cash settled market, and we are looking at a daily time frame. Now, if you caught last week's video, our title of that video was the most important levels to pay attention to. And what we were referring to in that video, and what we spent a lot of time sort of looking at, was this range that was developing here in the S&P 500. Now, and really all of the major indices, because they all had a very, very similar setup. Now, last week, of course, we only had this type of view here. So actually, no, this includes Monday. So we were looking at this chart. And so even with this only 4-day trading range in place, we still had the ingredients of some very key levels that we could start using and trading against, because with a VIX over 25 and, you know, almost 30, 25 to 30 in that zone, and with, you know, a move this overlapped and sideways, this gives us very clear levels to trade against. It's in fact one of, you know, my favorite setups. I think probably lots of traders feel this way, is when you have those clear supply resistance areas defined, in this case about 40.80 here, or all the way up to about 41.80. So 40.80 on the support, 41.80 on the resistance. That is what we were looking at for a potential breakout zone, a volatility expansion zone. And so when we came into this week, we actually continued in this fashion here. We continued this pattern for another several days. So we had a total of about 7 trading sessions moving very sideways here, very tight, very coiled, very spring loaded. And my bias last week was in fact to the upside. We talked about sentiment being very negative. We talked about seeing a second leg higher here. likely catching the most amount of traders off guard. That obviously did not happen. Fortunately, we never really got any kind of breakout move that faked us out. So the market never even, got over that 4180. It didn't start to, rally higher, suck in some of those breakout traders, which I definitely would have been one of them. And then, just drop to the other side. We just went sideways, put in a bunch of inside bars and some, engulfing bars. And then ultimately on Thursday is when we got the breakout, but it was to the downside. So for this market, we essentially found ourselves in a continuation pattern here. We had this little bear market rally. We had this little bear flag, a little rebound, counter trend rally, however you want to label it. We went sideways for 8 days, 7 days, and then we broke down and saw the breakdown on Thursday, close at the lows, the gap down and follow through day to the downside after the CPI print hit at 8:30 a.m. Eastern time. So that is really the landscape here for this week. It was a dull, quiet start of the week, followed by volatility expansion to the second half of the week. This really, hopefully, wasn't something that really caught you too off guard, because we did kind of game plan roadmap that the vol expansion would be coming. Again, we did talk about the scenarios to the upside, but regardless, that ended up breaking down and expanding lower. So when I look here at this market, all eyes are now back to these May lows. So the May lows really come in, of course, right around here, right over 3,800 or so. We basically got down to about 3,810 on May the 20th. Now, what we, if we want to put our optimistic hat on here, if you are, trying to hunt for a bottom or, really play for some upside in this market, you're looking for this support to hold. You're looking for a higher low to hold in here. You're looking for some type of washout and some, range to develop in here. And, this optimistically could be what we're, in store for this summer, is just a range that develops between, let's say, 3,800 all the way up to about 4,200. And the market can, potentially bounce around sideways here and hopefully, kind of catch its footing, gather some strength, and, go from there. That's the optimistic route. The pessimistic route is that the intense selling that we saw on Thursday, followed through on Friday, will basically just continue here Monday morning and challenge this support and ultimately slice through it and continue this downtrend lower here. So that is obviously the bear case. We are in a primary downtrend, and path of least resistance is still, in fact, lower. So if we do get this continuation next week and we start taking out these lows, there's not a whole lot of levels we can look at here. I mean, this could fall pretty quick, pretty fast if we really lose these May lows and we can't get any buyers to show back up. So we do need to be careful. We need to be cautious. We've had two days of pretty intense selling here. So maybe a little bit of an attempt higher here, and then we'll see how the market reacts. Ultimately, though, we have the 3840, 3830 zone to pay attention to next week in the S&P 500, and that's really, about as close or as tight as I want to look at this right now. Until and if we can start reclaiming and getting back over, 4,100 or so, my enthusiasm has certainly been dampened here after Thursday's breakdown. Maybe, again, sentiment still being as negative as it is. Maybe these lows do in fact hold here and you can get some type of buyable opportunity about 50 handles lower from now, but we'll have to wait and see how that responds. If we look at any of the other markets here, it's pretty much the same thing. We had a very similar setup. The Russell 2000 was looking the best out of all of them because it was, grinding higher here. And in fact, you can see it got as high as about 191, a very, very clean sort of retest of this prior breakdown zone. Of course, that breakdown, that test had failed. We saw three days of selling, and we're back down into the 170s here. We've got a slightly different look there. The Nasdaq 100, though, again, take a look at this very, very tight, orderly sideways consolidation we had in here for about 7 days. We slammed through it on Thursday, follow through on Friday. So again, similar comments to the S&P 500. Let's see how we react down here in the lower to mid 280s to see if these May lows can hold. We do have some momentum divergence that's brewing here on most of these charts, but we're going to need to see those lows hold. We're going to need to see buyers step up here after these days of selling. So that is the real just sort of nitty gritty price action levels that I'm paying attention to there in the major markets. I want to move our attention now to some of the bond funds here. So the IEF, so this is that 10-year bond fund. You can see it's cutting down to new lows here. This is something we've talked about a couple of times here as well, but especially on the growth tech Nasdaq type stocks, this is, you're going to want to see the IEF stabilize here. So again, best case scenario is we reject these lows very quickly here on Monday, right? And if we can pop back up and hold these May lows, that gives us more, I guess I would say, comfort in thinking that the Nasdaq could in fact hold its lows as well. Because especially the Nasdaq tech stocks, they're highly correlated or highly sensitive to what interest rates are doing here. And so if interest rates continue to slog lower, and if they continue to just slice down here and continue in their downtrend, then there's probably little hope that the Nasdaq is going to in fact hold its support. So I do think looking at IEF is sort of secondary clues or even primary clues as to market direction is very helpful. TLT, again, you can see a little bit less sensitive. We talked about this, the longer end of the curve, not quite pricing in or getting as aggressive or jumpy on the interest rate side of things. We talked about energy and oil. You can see oil here, again, having that good week, up 0.74%. Breaking to new sort of cycle highs here. You can see volume has dried up, the ranges have dried up, but this continues to just steadily trend here at highs. So we had a little bit of a sort of reflex move on Friday, but given the fact of what the dollar did, I mean, this held up pretty well. So we'll keep an eye on it. If we start losing maybe the March the March highs right in here, then maybe you could, if you're an aggressive trader, you want to go for a counter trend sort of double top here, then, that's I guess in play, but would be counter trend. Natural gas continues to work here. Of course, lots of sort of headlines there. We had a fire out there disrupting some of that supply, but UNG here and some of those producers are continuing to hold up in this strong trend, continuing to just grind higher here. So very, very impressive move out of natural gas. Gold. So gold is something I want to talk about. So on Friday, of course, we had the CPI print. We had all that market volatility. Take a look at what gold did. It started the day down about 1%, maybe not quite 1%. Yeah, it was about 1%, all the way down to the low 170s. And look at that reversal that got put in here, and look at the heavy volume that got put in this week as well, this day as well. So this is the heaviest volume day that we've seen since gold peaked in March, where it hit its sort of highs here in the 190s. And you can see the very, very heavy volume came in, bullish engulfing bar, basically engulfed the last 6 days of trading and closed near the session highs. So GLD looks pretty convincing here that buyers want to step in, put in this higher low, and that it can stabilize. We're going to want to see follow through. We're going to want to see commitment to this move, but that's a pretty good looking bar there for gold. I do have a position in gold that I added, and gold miners also here putting in some very heavy volume and engulfing the prior couple of sessions. This was up almost 5% on the day. Again, very heavy volume day here. On the week, it didn't do a whole lot. It just put in this big tail to the downside. So we do want to see some follow through. We do need to see some follow through, get through these highs, and commitment to the up move. But gold miners and GLD, I have a position in both of those. I'd like to see them work. And, if they can't get the follow through, if they start to give back most of this week's gains, then I will, swiftly step aside. So that I think covers everything I wanted to talk about in terms of individual stocks. Let's go to our industry scanning here. We're not going to go through all these names because there's way too much showing up here on our bear list. So nothing shows up on our up list. So our bullish list, we scan sectors and industries every single week, and we look at those notable moves. There's nothing on the upside. Everything's on the downside. And it's just a diverse list of names here. There's lots on the real estate side, or the REIT side, I should say, and real estate sector. We've got a good, healthy mix of technology as well, and there are some healthcare in here as well. So I'm going to expand this list, and I am going to let you hit pause. You can look through these names. So basically, the way I like to use this list is to look at the industries that are making these moves. So if we look at agriculture inputs, for instance, this is the first name on the list. Take a look at the kind of heavy expansion lower here, kind of closing at multi-month lows. This isn't a nice steady uptrend. So again, I actually don't dislike this one too much. But if we look at something like airlines, that's kind of continuing to break down, and some of these other names, banks that are continuing to break down in a more sort of deeper sense, these are the things that get me a little more pessimistic. Some of these, certainly are going to be a little beaten up and quite oversold, but that's for you to look through this list and kind of see what's working to the downside. So that's it. That's what I've got for this week. Lots going on here. I am still working on updates to this video. So I've got a couple of other data sets. I'm just trying to juggle time and get some coding done and some different data sources to bring you some new views. So that is still on the roadmap. So stay tuned for some updates there. Otherwise, leave a comment below. Let me know what you're looking at this week. Has your opinion changed on the market after this week? Do you think those May lows can hold? Let me know what you're looking at this weekend in a comment below. And with that, I want to thank you for tuning in. As always, every Friday, long form, in-depth market analysis just like this. You can subscribe on our YouTube channel or always catch it at thetraderisk.com. By the way, we send out a newsletter on Fridays, or I should say Saturday mornings. And if you're not subscribed to that, you can check it out, traderisk.com/newsletter. And with that, I hope you have a great weekend, and I'll see you back here next week. I lied. I'm back super quick here with a update. I mentioned at the top of the video I was going to talk about materials as a sector, and I totally glossed over that. So let's do it really quick. XLB, this is the Spider Materials ETF. There's other ETFs you can look at here, but what I wanted to bring to our attention here was this year-long range that has been developing. I'm going to switch over to a weekly chart and really just sort of show the picture in a easier way to see this range. It's been consolidating between, let's say, $78 and about $92 here for a full year. And the material sector is interesting. I mean, there's lots of things in here, but from an industry perspective, and some of the stocks that make this up are names like the agriculture sort of inputs here. So some of the commodity producers, we've got chemicals in here, we've got gold names and packages and shipping containers. So there's a kind of a slew of different industries that all sort of make up this what they call the materials sector of the market. And this is a sector or a pocket of the market that has been showing some great relative strength here on that relative basis. So while many stocks are down 50-60%, especially in like the growth and some of the industrials, we've got this pocket of the market that is holding up a little bit better, still maintaining long-term uptrends, and there's still some opportunity there. So this is where, for instance, the Merlin trading system that we talked about at the part 1 was doing some buying this week, was in this space here. And I think it's interesting just again to note the relative strength, to note this range that again, ultimately and open-mindedly could break down just as equally as it could break up, but it is sort of working off the big run up here post-COVID, and we're, kind of waiting to see what's going to happen in the coming weeks. It obviously had a pretty horrendous week this week, down 5.77%, but again, it is still, in the middle of this range, and we're going to wait to see how this plays itself out. So in terms of sectors here and in terms of directional bets, this is one that just like we talked about with the S&P 500 in a very, very tight 7-day range. Well, this is a pretty tight 12-month range. So this move will certainly extend itself beyond just a few days once it ultimately breaks out. So that's it. That's what I want to talk about there for materials. Thanks again for listening. We'll catch you back here next week.